Prepare to be astounded by the high-stakes drama unfolding within the US banking sector. Leading financial giants are sounding the alarm bells, heralding an era of unparalleled financial turbulence in the last months of 2023. Today, we embark on a journey guided by the insights of experts who predict a looming catastrophe. But before we go further, please make sure to subscribe to the channel and leave a like below this video. We appreciate the support. So what's causing this impending disaster? Let's dive into the heart of the crisis, which centers around the perilous state of US stocks. A recent report from Morgan Stanley sends shockwaves through equity markets. The promise of economic revival and increased consumer spending, which investors are fervently hoping for, may be on the verge of collapse. As we peer behind the scenes, a harsh reality is lurking, ready to shatter expectations. The Chief Investment Officer and US equity strategist at Morgan Stanley, Michael Wilson, paints a bleak picture, foreseeing a double-digit crash for the S&P 500. He points to manufacturing and business surveys flashing warning signs, revenue and earnings growth forecasts spiraling downward, and a looming wave of refinancing at higher interest rates. Wilson's words serve as a poignant reminder that sometimes optimism can be betrayed by harsh economic truths. Bank of America's strategist Michael Hartnett echoes this sentiment, warning of a looming economic contraction as the Federal Reserve tightens credit conditions and corporate earnings that fall short of expectations. They could cast a shadow over the already precarious economic landscape. But wait, there's more to the story. The once bright star of consumer stocks is losing its shine. Morgan Stanley's economists argue that the rally has peaked and household spending levels are unsustainable in the face of stagnant wage growth, surging consumer debt, and rising unemployment. The recent surge in energy prices is like an ominous storm cloud looming over financially strained consumers, threatening to push them beyond their limits. As we delve deeper into the market's underbelly, we discover unsettling news. Nearly half of consumer discretionary stocks are trading below their 200-day moving averages, a clear sign of distress. Recent market fluctuations are also causing businesses with shaky financial foundations to collide, while retailers report dwindling sales. In a world where investors bank on a miraculous economic resurgence, even the smallest piece of bad news could send everything tumbling down. The S&P 500, once a symbol of strength, now teeters on the edge of a precipice. US stocks, once a beacon of promise, now hang in a precarious balance. Their future is uncertain, and the looming challenges could result in a significant correction. A rocky October for the S&P 500, but that's just the tip of the iceberg. Jefferies Financial Group has cast a shadow over several companies, downgrading them due to fears that their profits and cash flows might plunge below their towering debt levels in the months to come. But wait, there's more. The financial institutions are waving a red flag over regional banks, hinting at potential trouble that could send shockwaves through the entire stock and financial markets. However, the real-time bomb seems to be ticking in the commercial real estate sector. Imagine a perfect storm. 18 months of relentless interest rate hikes, the work-from-home trend in full swing, and the unfortunate collapse of regional banks. All these factors have sent shockwaves through the world of commercial real estate, devaluing assets, squeezing lending, and leaving developers with mountains of debt. Financing, a lifeline for this sector, is in short supply, and the cracks in the foundation are becoming impossible to ignore. According to the Wall Street Journal, the vulnerability of financial institutions to the commercial real estate turmoil is even worse than previously thought. But why does this matter? Well, it's because a crash in the commercial real estate market can send seismic shocks not only through banks, but through the entire economy. So, where are these cracks? Michael Wilson, an expert in the field, paints a bleak picture of lower occupancy rates and soaring interest rates, signaling that commercial real estate is on the brink of collapse. Shark Tank star and financial advisor Kevin O'Leary adds to the gloom, stating that vacancies are on the rise, with up to 40% of buildings empty in some cities, like Boston. The impending correction in this sector is looming, and it's set to happen as rising interest rates collide with the need to refinance these debt-laden buildings. The result? Many of them have no equity left, leading to a looming crisis. Moody's Analytics chief economist Mark Zandi predicts that commercial real estate price declines will continue, spelling trouble for the banking system. Tesla CEO Elon Musk calls this issue more like an anvil than a shoe, suggesting that the worst is yet to come. But here's a dire prediction from Carl Bass, founder of HMan Capital Management. He estimates that the banking industry could hemorrhage a staggering $200 to $250 billion due to exposure to the crumbling office market. Regional banks, which heavily invested in commercial loans over the past decade, are now facing losses that could trigger a doom loop of further lending cuts and property price declines. The alarm bells are ringing loud and clear, and banks are taking drastic steps to protect their cash holdings from sinking further. They're even willing to pay a premium for this safeguard. In response to the Fed's tightening policies and rising interest rates, cash is draining from the banking system at an alarming rate, reminiscent of the pre-Lehman crisis era. The risks have reached such heights that regulators are stepping in, forcing regional banks to issue debt and bolster their living wills to safeguard against more failures. In the world of finance, the storm clouds are gathering, and it's a race against time for banks to secure their stability. Banks are being nudged away from holding the debt of other lenders to minimize the risk of financial contagion. This prudent measure, though essential, comes with a catch. It's poised to put the squeeze on some already struggling banks grappling with rising funding costs. In fact, some experts estimate that these requirements could eat away at these banks' annual earnings by up to 3.5%. Now the plot thickens. Analysts from Morgan Stanley, led by Manan Galia, have identified 5 banks on the precipice of danger: Regions Financial, Citizens Financial, Northern Trust, Fifth Third Bank, and Huntington Bank. But here's the kicker. Data released earlier this year by regulatory leaders suggests that nearly 200 banks across the US could be at risk of widespread failure. Why, you ask? Having long-term debt on hand can act as a lifeline, reducing the costs to the FDIC's own deposit insurance fund. It enhances the likelihood of a seamless weekend auction of a bank in distress, eliminating the need for extraordinary measures reserved for systemic risks. Regulators gain more flexibility in this scenario, potentially replacing ownership or breaking up banks to sell them off in pieces. This is more than just a warning shot across the bow. It's a clear sign that government officials are gearing up for what could be a tidal wave of bank failures, as concerned depositors increasingly withdraw their funds to safeguard their financial well-being. Picture this: if even a handful of major banks follow in the footsteps of Silicon Valley Bank's fateful path in March, it could set off a chain reaction of bank failures, perhaps the most devastating credit crunch in 2 decades. Access to credit for businesses and consumers alike could become an uphill battle, spelling disaster for the US economy. A bank run on one of these vulnerable institutions could send shockwaves throughout the financial system, as depositors rush to withdraw their funds from other banks, sparking a wider panic and eroding confidence. The stakes are high, and the clock is ticking. It's a scenario that's keeping regulators up at night, and it's a stark reminder that the time to act may be now, while the exits are still open.